Welcome to Yahoo Finance Live and happy Friday. I'm Shauna Smith alongside Dave Braves. We've got 1 hour left in the trading week, so let's get you up to speed on the market action. And stocks moving lower this afternoon. They are in the red as two big stories dominate the conversation. First is the collapse of Silicon Valley Bank, which catered primarily to tech startups. Now, the bank's failure is raising some concerns out there that other banks may also be in trouble and dragging down the financial sector.
The other big story is the stronger than expected jobs report. The U.S. added 311,000 jobs in February, with the unemployment rate ticking up to 3.6%. Wage growth, however, was slower than expected, which has investors questioning how the Fed's next rate hike will be.
Lots to discuss today, but first, let's get you up to speed on what happened at Silicon Valley Bank. Now, a run on the banks, it is a phrase that's usually associated with mass panic on Wall Street that then bleeds into Main Street. When you think of a run on the banks, now the Great Depression or maybe the Great Recession come to mind. It's when clients withdraw their money from a bank because they're worried about a collapse and getting their money out. The financial crisis of 2007 and 2008 led to more than 400 banks closing through the end of 2011. Well, the phrase, a run on the banks, it's back in the mix today, but the situation is a little bit different this time around, at least so far. So let's get into it. Now, the regulators shut down Silicon Valley Bank, known on the street as SVB, earlier today. The FDIC, or Federal Deposit Insurance Corporation, has taken control of the bank deposits. For background, SVB's big focus was funding for Silicon Valley and riskier startups, setting it apart from most of the other lenders out there. But as startups struggled with a funding drought, in part caused by the Fed's higher rates, funders then tapped their savings, resulting in a big drop in SVB's deposit. And that raised some questions about the bank's solvency. So here we are with a bank failure. So what's the fallout, the ripple effects on the financial system? Lots of questions out there, but classic runs on the bank, they typically hurt the entire system. Yes. More than $50 billion, $52 billion to be exact, in market cap was wiped out from the four biggest U.S. banks on Thursday alone. But pros, though, they are telling Yahoo Finance that the major banks, they are much better capitalized and more diversified than SVB. So maybe this is a standalone event here, Dave. Regional banks, though, tell a bit of a different story.
Yeah, let's check on First Republic Bank. You'll see that stock down 12+% today, and in the last week down more than 30%. Another one you're seeing some collateral damage. Signature Bank down 20+% today and down 37% in the last 5 days. What scares you is that quote from SVB: partnered with nearly half of all venture capital backed tech and healthcare startups. That is a terrifying damage done there. And also Bill Ackman earlier today comparing this to Bear Stearns and saying it is time for a bailout. So hopefully it's isolated. It would be hard to believe that it is. Seriously, a big issue here for us. Let's break it all down. The risk, what it means for investors. What we have with us, Ken Leon, CFRA Research Director of Equity Research, as well as Lee Munson, Portfolio Wealth Advisors, President and CIO. Gentlemen, good to see you. Earlier today, Treasury Secretary Janet Yellen said she's monitoring, quote, a few banks. Listen.
There are recent developments that concern a few banks that I'm monitoring very carefully. And when banks experience financial losses, it is and should be a matter of concern.
Indeed, a matter of concern. Ken, what is the collateral damage here?
Well, it's not going to be systemic damage as much as sentiment for the financial sector and banks. We're seeing that in bank stocks today. Liquidity risk is really what's front and center. And since the financial crisis, what's in place, particularly for the largest banks, is diversification with their source of funds, their deposits, how they manage that. And the likelihood is that maybe the Fed this weekend with Janet Yellen is going to be working for a potential buyer for SVB Financial. That's what we think.
Lee, what do you think when you take a look at the losses here, especially what's happening in some of the regional banks? First Republic, Western Alliance Bancorp, PacWest, among the worst performers in that group today. Is there a risk to some of those smaller players?
Yes. Did you see Janet Yellen's eyes in that clip? Did you see how they got really wide-eyed? This is a big deal. Remember, everything counts in large amounts, as Depeche Mode said. We've got banks in Silicon Valley, and don't forget biotech. That's a huge thing that we don't really talk about, but you've got 93% of the demand deposits over at Silicon Valley Bank were uninsured. You kind of wonder if the tech bros understand the idea of treasury management, which is when your deposit isn't insured, that's why you put in treasuries. And sometimes historically we got less interest. So I think that the regional banks, over the last few years, regulators have been hands off. They said, let them innovate, let them try to promote private equity, since that's what all the pension firms are counting on for their underfunded pensions. And so I think that if you want to play this stuff, I would play the sell-off in the major banks. I mean, come on, you can get Bank of America at 1 times book value. You buy big banks at 1 time book and you sell them at 2 times book. So that's a better related trade. The second related trade is go look at mortgage REITs. I've been into mortgage REITs in and out since COVID. Those got smashed up today, and I think that's a related trade that can do well. But remember this. These regional banks did not have the handcuffs that the major money center banks have had since the great financial crisis. When there's smoke, there's going to be fire. So I don't think people should necessarily be bottom fishing. I think none of us here are smart enough to really figure out what bank is going to survive or not. And I think that, if you're looking at the debt, that is a game for experienced, distressed bond investors. Let some guy like Howard Marks figure that out. But I'll tell you, there have been so much political contributions by Silicon Valley. We're going to see if that money is going to pay off, because if we see Sunday night the government come in and say, we've got to help this out or we're going to have a cascading problem in private equity, then you know that, giving to candidates who are in charge could be a good investment.
Ken, I know he had you with the Depeche Mode reference there. I know you had them on your Munson bingo card, but what's your reaction to his thoughts on the regional banks and the regulation as we look in the rearview mirror?
Well, it's all going to depend on scale and size and how aggressive they might have been with the book. Ideally, when you're looking at where you put deposits to work and it's not loans, it's treasuries. So I think the concentration risk here is, as noted, is industry specific and trying to have your foot to the pedal for Silicon Valley or venture capital, healthcare. Again, the larger banks or the regional banks are likely to take a step back and think about where they're putting deposits going forward. This might have a negative impact on the mortgage-backed security market, as the Fed is doing quantitative tightening of about $35 billion down on its balance sheet every month. What that means is possibly some of the indirect results of this is higher mortgage rates with less liquidity in the MBS market, because banks still are protected by the accounting rule is that they have liquidity and deposits, which are 20% greater than the industry's exposure to these investments in Treasury or mortgage-backed securities. They can keep them as unrealized losses, as noted in their 10K reports. But if you ride that road, then the question is, going forward, probably they're not going to be doing that or putting more into those categories. It'll be very interesting to see how that plays out.
Lee, I know you were saying in terms of where you're seeing opportunity right now, you would recommend buying a Bank of America, that they look attractive at current valuations. When it comes to what you should avoid specifically within the regional banks, what is at the top of that list?
Every single regional bank I would avoid. We don't know what the full extent of demand deposits, which are a much larger part of regional banks' liquidity, are going to be flying out, not just because of Silicon Valley. This was somewhat of a slow burner issue that just came to head this week, but also because you're looking at your local credit union, you're looking at your small bank, and you're saying, why am I getting 2.5%? Why don't I yank that out, throw it in my brokerage account, and buy some 6-month treasuries getting 4.5 or better? That is what the problem is, and we don't know. The smartest people in the room do not know how much effect that's going to be over the next 6 months, especially when the Fed has made it clear we're going to keep on it and we're going to keep raising short-term interest rates. I've got clients who are sending me a lot of money, not necessarily to put it in the market, but just say, can you just put this in a short-term treasury? Because I'm not getting anything at my small local bank. That's what the concern is. And I think when we talk about contagion, that's what it's about. People are using bank, I've got a Bank of America account, just for full disclosure. I'm not going to pull 100 grand out of it and put it in a 6-month treasury because there's other reasons why you use a big bank. But the smaller stuff where you have the little passbook savings accounts, remember, this happened in the late 70s. It's going to happen again. It's going to happen right now. But I agree with Ken. Listen to Ken. He knows what he's talking about. This is not going to be a full-blown disaster. It's a regional bank. So just stay out of the group. Find something else to trade.
Your reactions to that, Ken, and big banks, Shauna mentioned, saw $50 billion trimmed off their market cap on Thursday alone. Any further exposure for them?
Yeah, so the blanket statement is if you had 100 billion or more in assets, your deposits were safe. It was a good mix of consumer or small business, but SVB Financial was 216 billion. If you read the FDIC release today, press release, the caveat is for those account holders that have more than $250,000. That's not insured. So that's step number one. Step two, take a look at the banks for investing where they have diversified deposit mix. They're going to lose a little bit on spread because they're shifting from non-interest to interest-bearing deposits or CDs. But it's a good time to really look more specific, and that's why CFRI research is a good source for you to look at.
Lee, let's talk about what this could mean here for the Fed. Lots of talk about 25 or 50 basis points at the next meeting. Does this make it more likely that the Fed's going to go 25?
I think it is. I never really bought in this whole 50 basis point thing. I just think that was just, everybody's just getting upset. I think there's a delayed reaction a couple of weeks ago when you saw the 10-year Treasury hit 4%, and then nobody panicked. The markets didn't collapse. And even I was a little bit like, is everybody on spring break? But I think that idea of 50, I think that was just sort of an imagined thing that idea got away. So I think you're going to see 25 now. I think, in the next meeting in a few months, you're going to see another 25, and that's it. I don't think that right now they're going to really get too aggressive. But what do I know? All I do is listen to what the people in charge say, and they are gearing towards a 25 basis point hike.
That's what we all do, Lee. We all listen to the people that are in charge. Lee Munson, Ken Leon, thanks so much for joining us. All right, well, we are just getting started here on Yahoo Finance Live. Coming up, how will President Biden handle a potential bank run? Rick Newman joining the show for the latest installment of Bidenomics. And next hour, we take a look back at some of the biggest and most impactful reports from this past earnings season in our Yahoo Finance special after the quarter. And after the break, though, the jobs market is not cooling off, at least as much as maybe the Fed hopes. The U.S. economy adding 311,000 jobs in the month of February. We are going to dive into the numbers next.
More evidence of a hot labor market as we head towards the weekend. 311,000 jobs created in February, topping estimates of 225,000. The unemployment rate rising slightly to 3.6%, as did the labor force participation rate to 62.5. That's its highest level since March of 2020. And some good news for the Fed, and that average hourly earnings increased just 0.2% month to month. That is below expectations. Leisure and hospitality continuing to lead the way with gains of 105,000 jobs. What did we learn today? Let's hear from our panel, the Conference Board Chief Economist Dana Peterson and Invesco Global Market Strategist Brian Levitt. Nice to see you both. Dana, you are here in studio, so we will start with you and your one biggest takeaway from this morning's report.
The biggest takeaway is the fact that wages, average hourly wages on a year-on-year basis, ticked upward. That's really not good news for the Fed, because when we ask CEOs, what are you doing about rising labor costs, they're passing them directly to the consumer, and it's showing up in consumer inflation.
Brian, what about you? What was the one thing that really stuck out to you in today's report?
I was happy to see the labor force participation rate go up and back to early COVID days, which is a really good sign. People coming back into the workforce. The month change on wages was modest as well. So, given what's going on in the banking system, nobody would want to use the word Goldilocks today. But it was a good report in that the job creation remained strong, but the unemployment rate ticked up a bit and wages slowed. So all else being equal, not a terrible report.
And Dana, perhaps most importantly, how do you think Jerome Powell read this report?
Well, I think he'd be pleased and disappointed. So where he'd be pleased is the fact that we are seeing those pandemic darling industries such as transportation, warehousing, tech, manufacturing cooling off. And that's a function of the Fed's rising interest rates and also a shift in consumer spending away from mainly goods towards services. Where the Fed would probably be disappointed is the fact that you still have all this hiring going on, and it's mainly in those industries that are suffering from severe labor shortages like leisure and hospitality and also healthcare and social services.
So Brian, like Dana was saying, there's still lots of hiring clearly that's going on right now. So what do you think this means for the Fed's next move, and not just only its next move, but maybe its next couple of moves?
I have to think the Fed's getting closer to the end of this. I mean, the challenge that they've had in all of this is that when you raise rates the way they have over such a short period of time, things tend to break. And I understand that inflation is still well above their comfort zone. Directionally, we're seeing improvements. We've seen improvements in commodities and goods, stickiness in services. But the reality is they've raised rates so much. There's a lagged effect of it. We haven't seen what the implications of those lagged effects, and perhaps today we're starting to. And I believe that we're getting closer to the end. Once you start to have banking challenges, or dare we even say a banking crisis, the only thing that stops it is the end of tightening or policy support.
Yeah, the banking, the run on the bank that we saw today, any impact on the broader economy? And the market did move today to price in a 25-point hike. It was at a 50 just 24 hours ago. Do you believe this moves the Fed to a 25-point hike?
Well, I mean, unfortunately, banks do go under sometimes. And the thing is that, does this become systemic? If it can remain contained, then the Fed can continue to focus on inflation. But if it does become something where it feeds into the real economy and potentially causes a crisis and a recession, well, then the Fed might pull back. But I think for now, the Fed is very much focused on inflation. We're going to get another inflation report next week, as well as retail sales, to see how consumers are spending and if they're continuing to spend as much as they have been.
Dana, what is your read on the consumer? Because we heard from a number of the larger retailer players out there that they were seeing a pullback. A lot of consumers were trading down in many instances to some of those private label brands. Is that an indication that maybe the consumer isn't as strong as some of those headline numbers do indicate?
I think so. And when we look at our own consumer confidence index and we ask them, what are you planning on buying? They said, we're not looking to buy big ticket items or durable goods like cars. We're not going to look to buy homes or furniture to go into the homes. But the interesting thing is that they said they're also not looking to go on vacation. And we know vacationing and experiential services have been really hot. And so we're seeing some cooling in intentions, and we're expecting that to show up in the consumer spending.
Okay, so Brian, the data we'll get next week, a couple more reads on inflation. Do you expect the Fed will get the news they need? And do you believe a 25-point hike is their rationale at this point?
25 basis point hike is the rationale. I never fully believed that we were going 50 basis points. Will they get the data they need? We'll see. I mean, anything can happen month over month, but directionally, we're moving in the right way. And to Dana's point, even the services that consumers have been spending on, that should start to moderate here. So whether or not they get it in March, we know it's coming. And you know, I know the Fed always says that they're data dependent. I wish that they would be focusing on things that were more leading. I mean, money supply growth has simply collapsed. Business inventories are up. To me, it's time to stop raising interest rates and assess the damage that has been done from all of these rate hikes. But, you know, again, 25 basis points on Tuesday or 25 basis points at the next meeting is likely in the offing.
Dana, do you sense it's time for a pause?
Well, we think there are probably a few more rate hikes. We have priced in March, May, and June. We had 25 basis point increases each, but certainly whatever happens next week, I think is going to be really important in terms of whether the Fed really does go 50 basis points. But I have to agree that we are probably getting close to the end and there are only a few more hikes priced in.
All right, all eyes will be on that upcoming data next week. Dana, thanks so much for coming in here in studio. And Brian Levitt, always great to see you. Thanks. Have a good weekend. Well, coming up, what does SVB's collapse mean for the Fed? Or what about President Biden? Rick Newman has more on that right after the break. Let's do a quick check of the market, sponsored by Tasty Trade. You are looking at losses across the board as the failure of Silicon Valley Bank really adds to that broad market pressure. The Dow off 330 points here. The Nasdaq off just over 1.5%. All 11 of the S&P sectors in the red this afternoon. The KBW Bank ETF, which is comprised of regional banks, that ETF off just over 3.5%.
Tech-focused lender Silicon Valley Bank getting shut down today by regulators after a run on deposits. Yahoo Finance senior columnist Rick Newman here with more on this. Rick, what does it mean for the economy and for President Biden?
Anybody who knows the details of the 2008 financial crash, I think has heart palpitations when they hear about a bank failure, especially a fairly large one, and this would be the biggest one since the financial crash. If this is a one-off, then we probably are okay, but there also is the chance that this signals there is some meaningful stress in the banking industry that could affect other banks, and probably not the big ones, probably not the so-called too big to fail banks, JP Morgan, Chase, Citibank, and so on, but possibly the regional banks could have similar problems. And this all stems from what's going on with interest rates and the rapid rise in interest rates. So, you know, what seems to be happening here is this bank lost some deposits, and so it had to liquidate some assets in order to cover those withdrawals. And because those were Treasury securities it bought when interest rates were very low, it had to sell them at a loss, and those losses basically became unsustainable, and it created what is basically a bank run. This is alarming. You know, I mean, again, it's possible this is a one-off, and this is not going to create some kind of contagion. But boy, banking regulators sure better be paying attention, and it's certainly not a surprise. We've seen the KBW Bank Index down, I think, something like 16% this week.
And Rick, it's interesting. I don't believe we've heard from President Biden on this yet, right? He hasn't commented specifically on this failure.
Right. So Biden has had a couple things to say today. Of course, he said, wow, what a great jobs report. And it was a great jobs report. Interestingly, the White House this week has also been bragging about the American Rescue Plan, which is the stimulus bill that Biden signed 2 years ago and put nearly $2 trillion into the economy. There's some cognitive dissonance there, because the American Rescue Plan was one of the things that contributed to the rise in inflation, and inflation in turn forced the Federal Reserve to raise interest rates at almost the fastest pace ever, which produced the squeeze that seems to have led to the failure of Silicon Valley Bank. So no indication of that at all from Biden. He's just kind of saying through these fact sheets and press releases from the White House, the American Rescue Plan has done all these great things for America, completely eliding the fact that the American Rescue Plan also was a major contributor to the inflation that we now can't shake. So this is yet another reason that inflation is so pernicious. It just causes a lot of problems, including this one with the bank failure this week that I think nobody saw coming.
All right, let's turn now to Ron DeSantis, who could be eventually the opponent for Joe Biden in 24. But you don't hear DeSantis talk a lot about Trump, who he'd have to beat, nor Biden, who he'd have to ultimately beat. You do hear him focused on the boogeyman, wokeism. How are we seeing that play out?
Yeah, I've been starting to pay a lot of attention to what DeSantis does with regard to businesses in Florida, and what he's doing with regard to this small liberal arts school there called New College. Basically, DeSantis swept out the board of trustees earlier this year and installed a bunch of conservatives who are allies of his. And he says he wants to get rid of the woke agenda, or the politically correct agenda at this school, and replace it with, I guess, a more conservative agenda, maybe even turn it into a Christian school. But this took a weird turn recently because there's a foundation that's associated with this school. It's not a huge foundation. The endowment was only around $43 million. But there's been some reporting in Florida that the donors to this school have yanked something like $10 million from that foundation. So that's 25% of the funding for this foundation, which supports some activities at the school, and also was used to pay part of the salary of the prior president. Now, this gets a little bit weedy, but the new president, a DeSantis ally, the board of trustees, the conservatives DeSantis put in, they gave him a huge pay hike, and they thought this foundation would be able to pay most of that money. And the foundation is basically saying, you can't take this money to pay the DeSantis allies' salary. So there are a lot of questions about where this guy's salary is going to come from, how it's going to get paid. And I think if you're thinking about DeSantis as a possible presidential candidate in 2024, you have to ask yourself, what in the world is he doing? What's the point of all this? Why cause all this turmoil? DeSantis says, I guess DeSantis thinks it's so important to rout wokeism from schools and other institutions that he's willing to do all this, drive donors away and things like that. But in the meanwhile, the college is suffering, it's losing some money, and people down there just wonder, why in the world is he doing this?
I think a lot of people are wondering that, and clearly it's not going as planned, it doesn't look like. Rick Newman, thanks so much. Have a good weekend.
Bye, guys. Same.
Well, coming up, is Mark Zuckerberg prepared to go head-to-head with Elon Musk and launch a new social media app? We're going to discuss those details next.
The 2023 Oscars is looking a bit different this year as streaming giants come up short and the focus shifts once again to traditional Hollywood studios. Here's how we got here and why the decline in streaming nominations might not be as dire as it looks. Streamers garnered about half the amount of nominations in 2023 compared to 2022, with the big three, Netflix, Apple, and Amazon, receiving just 19 nods in total versus last year's 37. Netflix was the most nominated of the bunch with 16 total nods, followed by Apple with 2 and Amazon with just 1. Keep in mind, Apple actually walked away with Best Picture in 2022 thanks to Coda. At the time, the win was categorized as a huge breakthrough moment for streamers, and it seems like finally the lines between traditional film studios and streaming exclusives had been blurred. But it seems like the Academy isn't giving in that easily. In fact, streamers were completely shut out of popular categories this year like Best Director. Remember, Jane Campion won in 2022 for Netflix's Power of the Dog. Not only that, but the number of nominations has been on a steady downward trend in recent years. Still, there's one big question to ask. Does this all matter? Oscar viewership has struggled, especially as the top moments usually end up on Twitter or YouTube relatively quickly. According to Nielsen, 2022's Academy Awards drew in 16.6 million viewers. That was actually up 58% from 2021's record low of 10.5 million, but still the second worst viewership number in the show's 94-year history. And let's take a movie like Knives Out, Glass Onion, for example. Only one Oscar nomination for Best Adapted Screenplay, but still the fourth most watched Netflix original of all time, with nearly 280 million hours viewed in its first 28 days on the platform. That's a pretty strong showing for a film not rolling in nominations.
Well, this is truly delightful.
Or what about Top Gun Maverick, Avatar: The Way of Water, two of the highest grossing films in 2022, and yet nominated just 2 and 4 times respectively?
Just want to manage expectations.
You see, before streaming, there were obvious boosts in box office receipts after a film was nominated or won an Oscar. But with all the changes in media, it's hard to really judge the quote-unquote payout of an Oscar win, especially for streamers, which care most about subscribers. So even though streaming platforms may not be enjoying the same level of Oscar attention as they received in the past, it doesn't mean they don't have just as much, if not more, visibility, with hundreds of millions of paying users at their fingertips. That being said, the Oscars is the biggest award show stage of them all, with many industry watchers adamant that Academy Award wins and nominations do still matter. It just might not matter as much to the streamers, which are way more focused on subscribers and profitability than Oscar statuettes.
All right, it's time for a triple play. 3 stocks that we're watching in the final 30 minutes of trading. We've got Allbirds, movie stocks, and Meta. My pick today is Allbirds. Shares are spiraling to a record low. You're looking at losses of nearly 50%. The latest results were a huge disappointment. The company reported a deeper than expected drop in sales and also announced that its CFO is going to be leaving the company. Telsey downgraded Allbirds to underperform, calling the results, quote, poor. And Piper Sandler, they're making the argument that visibility on the sales turnaround remains limited at best. That's certainly not good news here for the company. Allbirds, though, is making some moves. They're doing all they can to win back Wall Street's support. The retailer unveiling a new strategy, which includes slowing the pace of store openings, recalibrating its assortment to better attract what they're calling their core consumer, and also add some more seasonal color options. Hopefully, they see that maybe boosting sales. But Allie, they've got to do something. Over the past year, year, shares are down about 80%.
It's crazy. And I think about Allbirds, and this was a big trend, right? Back in the day, I remember hearing, oh, you can wash them, they're sustainable, they're comfortable, but that's not really a differentiating factor anymore. All of these companies are leaning into shoe types like that. I own several Allbirds. I gotta say, they are not the most comfortable shoe. They don't have a lot of support. They're not super practical if you're walking around a major city. We'll see if this turnaround could work. I think one bad move that they made was trying to go into the high performance category. You're just not known for that, you know, and there's so much competition. It was very risky within this macro environment. We'll see. I just think if you're a shoe, the sneakerheads, they're very particular, and a shoe brand, there's just too much competition.
I would agree with that take on the athletic shoes, and so would their CEO, because he said in an interview today that customers were not ready for us to serve them in that area, and then reiterated that we unfortunately lost a bit of sight of what our core customers fell in love with in the first place, which is that ease, that comfort, that shoe. You could wear anything. But to your point, Allie, I looked down at my own feet, and this is essentially an Allbird, but it's not made by Allbirds. A lot of people started making a very similar shoe. This is Peter Millar, and it's almost an identical shoe, but to your point, has a little bit more support. And I think you saw that across the category. A lot of people started making. They didn't really have a moat around what they had. Anyone can make that shoe. They definitely need to refocus on their core.
Yeah, and it's interesting because they have such strong brand recognition when they did come out their first several years as a company, and even in the public markets as a public company, they did okay. They just need to figure out how to win that core customer back. It could also be maybe a potential smart takeover target by some of those larger players in the space.
Yeah, maybe a VC firm. I guess we'll see. You might not be running in Allbirds, but maybe you're running to the movies ahead of the Oscars on Sunday. I'm watching movie stocks, the theatrical recovery story. It's been a bumpy one over the past few years as the industry looks to climb back from steep pandemic lows. Films like Top Gun Maverick, Avatar: The Way of Water helped boost 2022 box office sales, grossing $1.5 billion and $2.2 billion respectively. And they're being rewarded this year with Best Picture nominations. Historically, the Academy tends to shy away from those flashy, big budget blockbusters, which has been a big critique when it comes to the relevance of this award show. Viewership has also been on a steady decline, while the number of streaming nominations has also ticked lower. And guys, I'm curious if one, you'll be watching the Oscars this year, and two, do you think the average consumer cares if a movie wins this award?
Is it Sunday night?
Sunday night.
I will be glued to every single second of NCAA tournament selection show Sunday, so no, I will not catch 5 minutes. I do ordinarily watch only because my wife watches the award show. I think for the most part, we are in a post-award show world now. I think people are moving past them, but it's a great move that they have movies that people watch actually nominated. That's going to help. And let's not forget, ratings have been down, but still, Shauna, 16.6 million people watched last year. We'll never get back to the 30 plus or the mid 20s that we were in late pre-pandemic, but 16.6 million people is nothing to sneeze at. That's an NFL type audience, still pretty substantial.
Yeah, and will be interesting to see whether or not maybe the ratings get a little bit of a boost this year, considering all the drama a year ago. So maybe that's going to help them.
Invite Will Smith back.
Invite Will Smith. That, of course, that will get you some more viewers. Also, a lot of controversy. Yeah, exactly. But I think it's so smart that a lot of these more well-known names, the blockbuster names, are being nominated. That's also something that we heard from IMAX CEO Richard Gelfond earlier this week, talking about the fact that people recognize those names. Not only are they going to probably be more likely to tune in and watch the Oscars this year, but they might go and actually watch the movie again, and that could in turn benefit IMAX.
But you didn't answer. Will you watch?
What do you think? No.
I think no. Okay.
No, I'm not going to watch.
Maybe
I'll do the highlights.
You're one of many people that just go to Twitter or YouTube and catch the highlights.
You are required to.
Yes, I will be watching. I will be watching.
My play is Meta, moving from the metaverse, it appears, to taking on Twitter. Reuters today reporting that Mark Zuckerberg may go head-to-head with Elon Musk and launch a new social media app that directly competes with Twitter. A Meta spokesperson telling Reuters, quote, "We believe there's an opportunity for a separate space where creators and public figures can share timely updates about their interests." The app would reportedly be similar in its framework to Twitter competitor Mastodon, which had fewer than 2 million users in early January. Tom Hayes from Great Hill Capital telling me, quote, they're just trying everything, though at least with a mini blogging site like Twitter, there's some expectation that it could start to make money out of a much quicker timeline than the metaverse investment. As for the metaverse, Needham analyst Laura Martin says in a note, it will not drive revenue growth until 2030, way off. Investors not so impressed by this report. Stock down 1.3%, but still up well over 40% year to date. I think it's like a decent play. I don't think anyone's going to compete with Twitter in terms of the mass user base that they have, but I don't think it's an enormous expenditure or reach for Meta.
No, because they're in the space already, the social media space. They clearly have the tools, the knowledge in order to build this. You don't think it would be a big spend here for the company. It is interesting that, though, it kind of caught me by surprise after we just heard Mark Zuckerberg talking about efficiency so many times on its most recent earnings call. I don't know if going into a place like this is something that analysts or investors are going to get excited about, but I don't know, maybe I'm wrong. Maybe that is a way to pull in some more of that ad spend.
There's a decentralized element. I read that reportedly that could be something so similar to Reddit. That's interesting, but I just don't think we need another social media site of any kind from Meta or otherwise. So I'm thumbs down on this.
It'd be hard to attract. I mean, would anything make you leave Twitter and go to another form? Or either are you on Mastodon?
No, I haven't even heard of that before today.
Yeah.
I just don't think it's going to attract that many people. I think Twitter just has this presence that it's hard to shy away from that.
I'd also love to know, in terms of their actual market here, how large they think this could potentially get. Because like you're saying, Mastodon, when you compare it to Twitter, Twitter's just under 240 million-ish users?
Mastodon
huge
less
difference.
than 2. Yeah. I think we agree with investors. Coming up, all of us want to retire at some point, but how do you figure it out if you can't afford to do so? We'll give you some advice next.
One in 6 retirees are considering returning to the workforce. 55% of those people who are considering that want to return because they need the money. That's according to a new survey. Well, joining us now as part of a Retirement Ready segment brought to you by E-Trade, we want to bring in Catherine George, WealthStream Advisor, Senior Financial Advisor. It's great to see you here, Catherine. So let's start with the basics, because I think a lot of people want to retire. They want to retire early, but how do you know if you have enough money to do that? First off, let's talk about the factors that you need to consider when figuring all that out.
Yeah, it's a great question. And it's really complicated because everyone's situation is different from the other. So when you Google that question, the first thing that comes up is this 4% rule. And what does that even mean? It means that if you need $40,000 of replacement income, then you need $1 million to sustain you over 30 years. But there's lots of questions that brings that up. And what the 4% rule doesn't account for are things like taxes. $1 million in an IRA is very different than $1 million in a joint account. It doesn't account for one-time expenses. So buying a car or taking a vacation or buying a second home. It doesn't take into consideration your asset allocation, which is a whole nother topic, when clients are retiring. Someone that has all bonds probably can't keep up with that 4% rule. And lastly, and I think that we're entering this new age, as you mentioned before I joined on, is different retirement ages. People are starting and stopping. So how do we get around these difficulties? And so that rule of thumb might work for you, but oftentimes it doesn't. And so what do we do about that? Financial advisors will help our clients, and we project out into the future your expenses, your income, these one-time scenarios that you'd like to map out, like a home or a car, and grow all of that into the future and see what trajectory you're on. And that's just, it's tricky, but sometimes just getting help is the first step and having a plan.
Fidelity says the average person should save 10 times their income by age 67 in order to retire comfortably. What do you say?
It's really, it's so dependent on someone's situation. Pensions, do you have income coming in? Then you really don't need that much saved. But ultimately, it's not even so much as what you have saved, but it's what you spend. I've seen people that have loads of money saved, but their spending just can't sustain those levels. And I've seen people that have saved much less, but are going to retire very comfortably because of their spending level. So it's both of those in conjunction. It's how much have you saved and how much are you spending, and really getting a handle on both of those to figure out how much you need at retirement.
Catherine, what about where you live? How does that factor in?
It's a great question. Obviously, if you live in a high cost of living area, your expenses are going to be higher. You're going to need more from your portfolio. You're going to need more income. But I would say the number one kind of wrench that can be thrown in a plan is health costs. Health costs are rising rapidly, and we haven't seen stopping. So historically, those costs increase at 6 to 7%. And Genworth has plenty of studies that show, these costs are different across the US. And the most expensive places to have a long-term care effect are Alaska, DC, Connecticut, and Massachusetts. And the least expensive is Missouri, Alabama, Texas, and Oklahoma. So health costs are a really big factor. They're growing significantly. And I think they even said that 7 out of 10 boomers will have a long-term care effect in their lifetime. So it is something that you really have to be prepared for and create a plan for, in addition to just living your daily life.
Catherine, what about inflation? We talk about the fact that people are paying more and more and more in every aspect of their life. And to what extent does that potentially delay retirement?
Inflation is such a hot topic right now because everyone is seeing that inflation is incredibly high, but we just went through a historically low inflation period for quite some time. So when you average it out over long periods of time, it's typically around 3%. And so weathering these high inflation periods, you should also see some low inflation periods. So it's not about what's happening today or tomorrow. It's about what's happening over that 30-year span of retirement. So again, coming up with a plan, coming up with an investment mix that will be able to sustain inflation and your expenses, and not even just inflation for your regular costs, but these health costs that I just mentioned. So coming up with a good stock to bond mix that will help you reach your goals, but also sustain that inflation that is in the news right now.
All right, Catherine George, I plan to never retire. We appreciate the advice. Coming up, lower income Americans are facing more tax audits than some of the wealthiest Americans. We'll tell you why next. Studies have shown that many lower income families are getting more IRS audits than millionaires. And the process to deal with these audits are causing extreme burdens and stress for the taxpayers because they often don't have the resources to deal with the IRS. Here to break it all down for us is Yahoo Finance personal finance reporter Rebecca Chen. Rebecca, nice to see you. So what is going on with these IRS audits and how is it hurting taxpayers?
So in our couple surveys and research that came across in our reporting are showing that majority of IRS audits are going to lower income families. Specifically, data suggests that more than 50% are going to families making less than $25,000. And unfortunately, this is because it's easier for the IRS to audit lower income families. What this means is it is simpler and more cost efficient for them to send out a bulk computer-generated audit letters to lower income family than go to a high net worth income individual and do their audits by hand. A lot of the tax experts I've talked to say they have noticed that the IRS seems to target earned income credits. It's a tax benefit that primarily goes to help to lower income families. But the audit potential that comes with it is extremely stressful because audits are so hard to deal with and usually they take super long to resolve.
And Rebecca, how painful is this? Because this is a segment of the population that clearly doesn't have a lot of excess cash on hand.
So one of the most common issue I have seen during my reporting is that the lack of IRS resources itself. So when families get these letters, audit letters in their mailbox, there's no contact person, there's no number they can call to ask what's going on to get an explanation. Many times, and even if they call the IRS toll-free hotline, they may or may not get through to a live agent. So what happens is they are often stuck trying to figure out these notices themselves and trying to figure out what to do with them. So my suggestion for any audience member who are dealing with this situation is, first of all, do not ignore these notices because they could snowball into something a lot more serious. And the next is, if you have a notice where you're allowed to upload your documentation on the IRS portal, do that. Because this way you don't have to print out your supports, put them into an envelope, drop stamps on them, go to the post office and then wait for the IRS to get them. Just upload them onto the IRS website and it will cut down on a lot of lead time. And I know the IRS calling center hasn't been very helpful in the past, but we are hearing that the time is getting better. They are working on putting more representative to help the taxpayers. So it might be worth to try calling them. But if you prefer a more in-person approach, try to go to your local volunteer income assistance tax center. They can refer you to tax clinic that will help you with the audits. But if all else fails, if you have a very stubborn audit that just will not go away, try to go to the National Taxpayer Advocate, and they can help you there.
Does the IRS have any explanation as to why, any statement as to why they're auditing lower income Americans more than millionaires?
So we did reach out to IRS for comments, and the comment was, we'll get back to you. So far, we don't really have any explanation, but...
It's odd because they've said they need 87,000 additional employees. It's hard to really justify additional employees if, in fact, you need to audit those who make less than $25,000
Yeah, certainly
a year.
lots of questions there. All right, well, Rebecca Chen, great reporting. Thanks so much. We are just minutes away from the closing bell. Jared Blickery has a closer look at some of the selling that we're seeing once again today.
Yeah, selling in the equities market. I'm going to get to the bond market in a second because that's informative too. But here we're seeing the Nasdaq down 1.5%, the S&P 500 down about the same, and the Dow just over 1%. By the way, all the major averages this week having the worst week of the year. It looks like we're going to close out that way. I want to show you the 2-year. These are the futures that are trading, not the yield. This is the biggest spike up we've had since the day after Lehman failed and basically filed bankruptcy. That was a Monday back in September of 2007 or 2008. Now, do I expect anything like that this time? No, but probably going to be more fallout from this Monday. Lots of things in flux now, and the bond market signaling more distress than the equities market. Here we see real estate. Lots of leveraged real estate funds and REITs are exposed to SVB Bank. That's getting affected now. That's down 3%. Materials down 2%. Financials down 1.9%. The list goes on. Everything underwater, as you can see here. Let me just get to some of the action in the Nasdaq 100. Now, some of the standouts here, looks like JD.com down 3%, PayPal down 3%, but really we're not seeing a lot of huge fallout in the equities market right now, as witnessed by not a lot of dark red, especially in the mega caps. Mega caps are down, but don't seem that perturbed. Intel, by the way, up about 3%. We're also seeing some green in the staples like PepsiCo. Let's take a look at the leaders here. Some interesting action. I'm going to show you what's happening today, and then I'm going to get to what's happened this week. KRE, that is a regional bank ETF. We'll look at that for sure. Meme stocks taking a hit today are components, but let me just show you what's happened this week. Huge loss for KRE, those regional banks, meme stocks, ARK Invest. I'm going down the same numbers or the same words or the same nouns, but the losses are a lot steeper now that we consider 5 days. Chinese stocks, Bitcoin exposed stocks, cannabis exposed stocks, IPO, the list goes on. Here's our banking sector. These are some of the bigger banks, but really the action in today was centered in the regionals, and here we see, let me just organize this by best to worst, and even the best is down by 3%. SIVB SIVB, well, of course, that is closed nose. So that's reflecting the losses that we saw this week. Silvergate down 56%. A lot of these California banks also experiencing losses of 1/3% or more. So really just incredible price action. Let me get back to our sector analysis and show you what's happened this week. So everything's still in the red. Financials, not surprisingly, showing the least amount of damage here, followed by materials, real estate, consumer discretionary. But we really haven't seen that much carnage in the currency markets. And let me just go to the US dollar index and show you what I mean. Normally, in a time of absolute crisis, guess what? We see the US dollar getting bid, and we are not seeing that today. We're actually seeing the US dollar index down. So that gives me a little bit of relief heading into the weekend. Like I said, we are expecting some fallout from this on Monday. No idea where it's going to go, but hopefully nothing too dire. Let's close with some other markets here. This is what's happened this week in the energy market. That also taking a hit. Exxon down 4%. And there's your closing bell, guys.
All right, well, that marks the end of the trading week. Certainly a painful week here on Wall Street. All three of the major averages closing the day in the red. The Dow off 342 points as we shake out the final trades of the day. S&P also off just around 1.5%. The Nasdaq, the worst performer of the three major averages. Now, this market check sponsored by Tasty Trade. Coming up, we are taking a look back at the most recent quarter of earnings. We will dive into some of the winners and losers and also hand out even a few superlatives. Stick around for Yahoo Finance's After the Quarter special next.
Welcome back to Yahoo Finance Live. I'm Dave Briggs with Shauna Smith. For the next hour, we'll have special coverage of the Q4 earnings season, from record profits to unexpected losses. A lot to unpack from this quarter, but let's kick things off with our three biggest takeaways from this earnings season, Shauna.
And Dave, we got to start with the consumer. There was so much focus on the health of the consumer, how big of a pullback we are seeing as we do face inflation that still remains very stubborn. And it was clear from this most recent quarter that retailers are hurting and are seeing a change in terms of spending patterns from their consumer. Let's start with Target, because Target was one of those companies that said their private label brand is now worth more than $30 billion in annual sales. Well, they're investing more in that because more of their consumers are trading down, meaning that a lot of these private label brands are cheaper than the alternatives that are sold in the store. So that was a trend that Target was seeing in this most recent quarter. Private label sales growing 18% in 2022, outpacing Target's overall sales. And they're going to capitalize on this. They're going to launch more brands, expand some of the private label ones that they have. A total of 10 private brands is what they are working with here. And that lower cost, that strategy seems to be working for some of these retailers.
Yeah, we talked about private label brands, probably the single biggest trend in Q4 across all of retail. It's not just Target, it's Walmart, it's Kroger, it's grocery. It really has been reflected across the entire sector. And I want to focus in on Walmart, of course. You can see the stock basically flat on the day. They exceeded expectations because, of course, Walmart can lean into groceries. You can see again the consumer with Walmart earnings trading down. Inflation, higher prices really began to impact them, and their CFO talked about a, quote, pressured consumer. And that's another term we heard across most retail companies. The other one was cautious consumers. That was the description from most CFOs. They leaned into that grocery, but they also said fewer discretionary purchases from the consumer. And if there's one interesting soundbite, it came from CEO Doug McMillon saying, we're gaining share across income cohorts. And here's the key, including at the higher end, which made up nearly half of our gains in the U.S. this quarter. So the higher income consumer trading down to Walmart, and that's where they saw their biggest increase in terms of market share. Cautious consumer is I guess what we saw across all retail.
Yeah, and I think that might be a trend here that's going to stick for the current quarter and maybe even into the second quarter of the year and into the second half of the year, as we still don't see too much improvement in inflation. So we'll see.
And starting to see some signs of a recession in the second half. Layoffs plagued Wall Street. Meta, Amazon, Google, you really have to focus in on those huge names. You see 84,714 layoffs in the tech sector. And I focus in on those big three because Amazon in the fourth quarter announced their layoffs of 18,000. They, of course, are the biggest because the term is right sizing, and it's an icky term when it comes to layoffs, but it really is accurate when you look at Amazon, Meta, and Google, because they had to get back toward the right size. They overhired, compensating for that pandemic boom. It was not going to continue, but they hired like it was going to. And Andy Jassy had very little choice, scaling down, cutting down on some of those warehouses. Meta laid off 11,000. We heard just a few days ago they will lay off a few thousand more. And Google laid off 12,000 employees as they right-sized toward where they ought to be. They should have probably known those COVID gains couldn't continue, but now they're forced with reality.
Yeah, they're forced with reality. You mentioned some of those bigger tech names there. Also, Salesforce was one that made a lot of headlines, and they didn't exactly announce this on their earnings call, the 10% cut that the company announced in January. But there was some talk about how Salesforce is evolving. And we know Salesforce has been under a tremendous amount of pressure from a number of activist investors in the latest round of these cuts that are still ongoing. That 10% reduction in the workforce, sales and marketing roles are now reportedly being affected within that cut. But Salesforce saying on their earnings release, on their earnings call, CFO Amy Weaver, that it is a new day at Salesforce. Profitability is certainly front and center. And then also over in the payment space, Affirm, the job cuts there really across the tech sector at large. Affirm announcing 19% of its workforce would be cut. That amounts to about 500 jobs. And we had founder and CEO Max Levchin. He joined Yahoo Finance earlier in the quarter talking about these job cuts. Let's take a listen to what he had to say and why the company's doing it.
Like a lot of Silicon Valley, we had hired more people that we were reasonably able to support given the revenue growth. As the economy slows down, you can reasonably expect more slowing.
Reasonably expect more slowing, and Levchin also adding that tens of millions of dollars of operating expenses were taken out as part of those cuts. All right, well, it was certainly a rough quarter here for earnings. Inflation and the Fed raising rates hit a number of companies hard. Only 1.3% of stocks in the S&P 500 beat analysts' expectations. We want to bring in Michelle Snyder, MarketGauge.com partner and director of trading research education. Michelle, it's great to see you here. So inflation, one of the big takeaways in this quarter, the slowing economy. How did that shape this past earnings season?
Well, for one, the actual pricing in many cases have come down, but the interest rate impact, I think, was probably the bigger impact in terms of what's happening over the last quarter, the fourth quarter. And I think what we're going to see going into the first and second quarter is going to be more follow through on that. But in terms of inflation itself, if you look at it, there's so many dislocations in terms of how people are looking at inflation. And I think right now the biggest focus and what could impact earnings the most in terms of what going forward and the inflation numbers is exactly what's going to happen with the Fed's response to this banking crisis that we saw this week, because this is just the type of chaotic situation that we have not seen all the ripple effect from, but yet it could be that the Fed might be forced to pause and make that choice between rising prices or an economy under collapse because of a credit crisis.
Michelle, why do you believe this Silicon Valley collapse will change the thought process of Jerome Powell?
Well, because he's obviously watching very carefully what might happen to what we've seen with the overall market. Two would be, of course, the credibility of just the banking industry. I mean, this is the second biggest collapse of a bank since 2008. And three is because really what it does is it just shakes the foundation and the credibility of something that people often take for granted. I mean, for example, Wells Fargo, and I know we're going to talk about that a little bit later, but they reported today customers were not seeing their deposits reflected in their statements or their paychecks showing up that Wells Fargo does transactions with. So, this is just the kind of thing that can be a very, very not only chaotic situation, but an unraveling for the Fed because they're going to have to give some confidence back that they've got things under control. So choice, recession, or like prices goose up a little bit.
So Michelle, let's dive into some of the winners and the losers of this earnings season. Recession was one of the themes out there. Clearly, some of the leaders of these companies dealing with that threat differently. Who were some of the winners?
Well, in terms of actual sectors and industries, obviously energy was one of the biggest winners. They reported record profits. So that was a plus. Wholesalers, as you had mentioned before, Target and Walmart did very well, BJ's. And then also, I think that, some of the companies like Meta, because of their year of efficiency, brought in a lot of buyers. We've seen some incredible rallies off the lows, Tesla being another one. So that would be kind of where, and then some of the industrial metal companies, by the way, like, for example, Steel Dynamics or Century Aluminum, because of the demand that people are having in the EV space. So and of course, semiconductors, let's not forget about that with NVIDIA and Microsoft holding on. So I think that those are the areas that when passed. But I'm more interested in what happens going forward, and we'll see if those companies continue to be in good shape.
All right, how about some of these sectors and companies losing in the fourth quarter?
Well, in terms of losers, obviously banks, they started out well, but this has really put kind of a kibosh on them in terms of going forward. But the banking industry did not report as well and robustly as we started the earnings season for the fourth quarter. It'll be interesting to see. I think it'll be even worse going forward because forget about what happened this week. Just thinking about with these interest rates and people being able to go into more fixed income for a higher interest rate than they're going to get if they put money in the bank, that forces the banks to actually have to compete and raise interest rates, which of course will affect their bottom line profit. So they already started with losses. That could worsen, obviously, discretionary retail. And I know you want a couple of companies. We can talk about Lululemon being sort of a classic, one that I would be looking at as a potential loser for a few reasons. And I think we have to really see what happens here with just the supply and demand in terms of what it's going to potentially lose as far as even e-commerce, like in Amazon, for example, they've had their problems with layoffs. I think they have bigger problems because there is so much competition to them right now. And they've spread their costs so far that they've already started to break down. So we could see big surprises on the downside as they go forward into Q1.
Michelle, what about the strong dollar? How big of a headwind was that this past quarter?
Well, it was a headwind, but I think what's so interesting that happened today, and Jared mentioned this before, was that the dollar came off when generally it's a flight to safety. And that's going to be another big factor because the two aspects of inflation are rising prices and less purchasing power based on the currency. So the dollar, if it continues to go down from here, which it easily could be perceived initially as a good thing, because obviously things get cheaper, but it could also turn out to be a big negative if people can buy less with that dollar and the dollar continues to free fall, which would of course be more inflation.
All right, Michelle Snyder from Market Gauge, appreciate that. Thanks so much.
Thank you.
All right, as part of our look back at the quarter, Yahoo Finance's Josh Schaefer is here with some superlatives to hand out. Josh, what's up first, my friend?
All right, Dave, so we're going yearbook style today. We're going to do a couple different superlatives. We're going to start with, I think, my personal favorite, life of the party, right? Everyone wants to get life of the party.
Is that you?
It's pretty fun. I did not get life of the party.
Oh.
But I just think it's a fun one, right? So we got C3 AI as life of the party, and really, more broadly speaking, AI as a whole, right? AI was mentioned over 100 times on a combination of earnings calls looking at Microsoft, Google, Meta, NVIDIA. And really, it's been interesting to see, guys, how the market has reacted to how different companies when they mention AI. So different companies, as they've mentioned AI, they then sort of spike up, and it's been interesting to sort of see that stock market reaction from those companies. Now, one thing I did want to ask you guys too, as far as AI goes, we're talking life of the party, something fun. I like Einstein, Salesforce's Einstein. What's your favorite AI name so far? We've got ChatGPT from OpenAI. Where are you guys leaning?
I like ChatGPT. I don't know if it's just because I've said it so much that it just rolls off the tongue at this point, but ChatGPT makes a lot of sense to me in terms of its applications and what it's used for.
It's the only one I've used, ChatGPT, and I think it's an incredible tool. Einstein, however, takes the prize there.
I stumble too much on ChatGPT.
Yeah, it doesn't roll.
Einstein GPT doesn't roll either. We need something a little bit more. I guess Bard from Google, not bad. But I think you're just confused with what it is.
Yeah, I don't like Bard.
Bard GPT, maybe. That also
All right, I do want to take a quick look at the stocks as I was mentioning here. So you can see NVIDIA, the way it sort of popped right here. That was after they mentioned AI a lot of times on their earnings call, over 70 times. Investors seem to like it. And then we'll take a quick look here too. I want to show you what C3 AI has been up to this year. C3 AI had earnings on in early March here, March 2nd. You can see that was an over 25% jump. And then you can really see how interested people have been just in the name as a whole. This is a company that is projecting profitability out in 2024, yet the stock is up 90% year to date, really sort of showing the excitement for AI. Not a lot of companies right now at a growth stage growing this much with this much investor sentiment sort of piling into the name. And we want to talk more about AI coming up next. We're sticking with AI. Who will win the big tech race? Is it here to stay? We got the answers on the other side.
This last quarter saw the rise of artificial intelligence AI, with ChatGPT launching the technology into the spotlight. But with many of tech's biggest players working on AI products of their own, who are the winners and what's the investment opportunity there? To discuss this, we want to bring in Will Summerlin. He's ARK Invest co-lead and analyst. Will, it's great to see you again. So during this earnings season, our colleague Josh Schaefer was just saying that of the big tech companies, AI was mentioned over 100 times on the earnings call. What was your big takeaway from all this hype surrounding AI?
Well, I think people are realizing its potential. With ChatGPT, we saw the fastest growing software product in history. It grew from 0 to 100 million users in 60 days. And so this isn't hype. This is customers seeing real value out of technology. I think when you think about the investable universe of AI, we really think about it in two buckets. On one hand, we have the infrastructure plays, the picks and shovels plays. So think of NVIDIA, for example, on the public side. On the private side, we just invested in a company called Mosaic ML, which helps companies train their own AI models. And then the other bucket is applications. So companies that are actually embracing AI and building customer experiences around that, helping customers solve problems using AI. ChatGPT is an example of an application. Another example of an application is AI coding assistants. There's a company called Replit, which is a growth stage startup that has a chat assistant or an AI coding assistant called Ghostwriter that's blown up in popularity. It's making software engineers more than twice as productive. And if you think about the value creation opportunity here, knowledge workers make about $32 trillion a year collectively. And we're already seeing cases where AI is doubling their productivity. And so the value creation here is going to be incredible. We think it might actually be the greatest form of value creation we've seen out of any technology trend. Greater than the internet, greater than mobile, greater than cloud. And so there's certainly excitement around the opportunity, and companies are really pivoting to capture the potential.
That is quite a significant statement, Will. In terms of sectors you see poised to benefit the most, is there one that stands out?
Yeah, I think knowledge work broadly. This applies to legal, this applies to software engineering, this applies to most domains of knowledge work. The incredible thing about AI is it really automates thinking. If we think about technology throughout history, it's automated physical labor. And so we saw this with a tractor. It made farms 17 times as productive. And we're starting to see this with knowledge work, where AI is actually helping us do tasks that require a lot of thinking. And so software engineering is probably the best example we've seen so far. We're seeing applications like Replit Ghostwriter. We're also seeing this from GitHub Copilot, more than double the productivity of software engineers. And that's a class of knowledge workers that's highly paid. $200,000 a year software engineer that gets double the productivity all of a sudden because of an AI coding assistant. That's incredible. We're also seeing this in legal, right? We're seeing assistants in legal that reduce the cost of contract reviews by 70, 80, 90%, because instead of having a human go through every single line in the contract, you can use AI to do the review and then a human just to look at the things where there may be issues. And so we think this is going to apply broadly. There are also areas where there is significant cost savings potential. And so if we think about contact centers, for example, labor in contact centers is challenging. It's a relatively unsatisfactory job. And so the churn is very high. In many cases, the churn is over 100%, meaning people actually don't stay an entire year once they join a contact center staff. So you train an employee and then 3, 4, 5 months later, they leave. That's an area where it's ripe for automation. We're starting to see companies like Twilio embrace that opportunity and build AI models to really automate contact centers. And so I think this is going to touch pretty much every form of our life, or every part of our lives, and pretty much every form of human labor.
So, Will, it sounds like you think it's going to have a significant impact on the job market. What's the extent of that?
If you look at technology throughout history, everyone always says that technology is going to lead to mass unemployment, and that's not been true in the past. Technology has always led to a higher quality of life, and it's actually spurred job growth. And I think the same thing is going to happen here. Humans are creative beings. And when we're able to get leverage over our time with technology, we find ways to create value. And so I think ultimately this will actually lead to a higher quality of life and probably be an accelerant to job growth.
Well, you've got some winners, and we have to ask you about Tesla and their advantage in this space.
So when we think about investing in application layer AI companies, we think about it on 3 axes. The first is a data advantage. Can they develop a data advantage that allows them to train superior AI models and really outcompete their competitors? That's an advantage that grows with scale. And so like network effects, the more data you have, the better your models become. The better your models, the more customers you get. The more customers you get, the more data you get. And this flywheel sort of continues. We've seen that with Tesla. They have billions of miles recorded through their full self-driving suite. And that's going to be hard for others to compete with. So they have a data advantage that's continuing to scale. Second is vision. Do they have a leader at the company who is going all in on AI and burning the boats and committing the company to the future of AI? And Elon is definitely doing that. It would be hard to argue that he's not. And third is distribution. Do they have a distribution advantage that they can leverage to deploy AI capabilities? Tesla certainly does. They already have a large fleet of vehicles, and the AI autopilot or full self-driving capability is included as a feature in those vehicles. So it certainly meets the three criteria for us.
Well, you're certainly making a compelling case for that. Will Summerlin, great to have you. Thanks so much. All right, Josh Schaefer continuing with the superlatives. Now we've got one of my favorites, class clown. Who is it?
All right, we're going to have a little fun with this one. The class clown is Bed Bath & Beyond. And there was a time this quarter where I think some people probably thought that Bed Bath & Beyond was going to file for bankruptcy, maybe even in this release on January 10th. That did not happen. Their last quarter was ugly. A lot of these quarters in a row have been ugly. So some numbers to hit on here. They lost $393 million in the quarter. Same-store sales down, net sales down 33%. And they're planning to close 150 more stores. And so when you take a look at Bed Bath & Beyond stock, guys, you can see that that fell. Let's get to a 3-month here so we can get back to January. They reported pretty early. You can see that that fell on this news here, and then it's had sort of that meme little vibe to it as well, and it's popped back up. But the stock now down below 134, and I want to point to that because really the story with Bed Bath since earnings has been that funding deal that they have. There is a part of that deal that if the stock sits below 150, that $1 billion that they're getting in funding over the next year could stop. So that's sort of the number you're watching. It's below 150 right now. In theory, when they go to get funded next month, it could stop if the stock remains below 150. So that's the number to watch with Bed Bath & Beyond. Again, taking a look at a longer term chart here, you can see it has not been a good ride for Bed Bath. They are our class clown of the quarter.
You know, it makes a lot of sense to me. It's just amazing that there are a group of investors out there who still see this as an opportunity and bet on it time and time again, despite all of these headlines and all the reasons that we are naming it class clown.
Josh, I think those are the same people that are going to bet on the WWE.
Right.
You know, I mean, the same people that are going to bet on a scripted event. In this case, we already know the script, how it ends with Bed Bath & Beyond.
Yeah, I guess maybe the class clown should have been some of the people that are sending this price up a little bit, right? As we keep
adding
talking
to
about
it. It's a whole
bankruptcy.
family affair.
Potentially. All right, coming up, how a slowdown from the consumer retail earnings. We'll talk with Corey Terlew from Jefferies on the state of the sector.
There's something in the air in Austin, Texas. And it's not the sound of fans cheering on the Longhorns, the twang of a country guitar, or the smell of Texas barbecue. It's South by Southwest, an annual celebration that's billed as both a conference and a festival, or somewhere in the middle. But as organizers and veterans will tell you, you just have to be there. It's a mashup of film, music, tech, and culture, a place where you can watch Iron Man lecture a crowd on cybersecurity, receive healthcare advice from the Jonas Brothers, or watch a movie premiere in virtual reality all in one afternoon. But why is this happening, and who's going? Well, everyone. Fans, entrepreneurs, thrill seekers, investors, and they're all going for the same reason. They're looking for the next big thing. Of course, I'm talking about AI, and what some are calling deep tech. Those scientific advancements which include innovations in areas like virtual reality and robotics. Between star-studded conversations and out-of-this-world exhibits, South by Southwest will give us a sneak peek into the future and how these new technologies will change our economy and our world, from the way we work to the way we play. We'll be speaking to the top thinkers and up-and-coming entrepreneurs about what all of this means for businesses, consumers, and of course, investors. Because we're on the edge of a brand new era in modern technology, and South by Southwest is the main stage. Over the past few years, there's been a shift in how we think about the tech industry and the emergence of a new capital city for American business. Tesla, Apple, Google, Oracle. Why are the world's most valuable companies all moving to Austin, Texas? Could it be the weather, the taxes, the food, or maybe it's the vibe? The answer lies at South by Southwest, Austin's coming out party, at the conference and the festival, or somewhere in the middle.
Let's do a quick check of the markets, sponsored by Tasty Trade. Once again, all three of the major averages closing in the red. The Dow off just about 1%. The Nasdaq off nearly 2%. The collapse of Silicon Valley Bank adding some jitters here to the market as we close out the week.
Retail earnings took a hit this season. According to Barron's, earnings across companies in the SPDR retail ETF declined by 31% year over year on average. Even for companies that saw growth in the recent quarter, executives are giving cautious outlook, saying that a slowdown from the consumer could weigh on future earnings. Listen.
We've seen some weakness in what I'll call big ticket discretionary items.
What we're seeing is the consumer making $80,000 a year is trading down.
There's just a lot that we don't know. We could tilt into a recession.
We saw a consumer that was feeling the impacts of inflation.
All right, joining us now to discuss what we saw from retailers this earnings season is Corey Tarlow, Jefferies Vice President, Equity Research. Corey, good to see you. How would you describe the quarter in retail?
Good afternoon, and thanks for having me. So I'd say that the last quarter in retail is really quite simple, and it's that not every retailer was created equally. I think that there were very simply winners and losers. Those that won were retailers that are value-oriented, have really convenient offerings and affordable prices, and frankly, skew a little bit more heavily into consumable products like food. And those that really, I think, felt the brunt of persistent inflation and a weakening consumer underperformed. So on the plus side, you had retailers like Walmart, BJ's, Costco, and Target do quite well. And then on the negative side, you had retailers like Gap that reported yesterday evening and the results underwhelmed, or American Eagle as well, that has continued to kind of underperform a little bit here.
What about what we heard in terms of guidance, the outlook, because that was so important this earnings season? We saw a number of these stocks really move on what the future outlook was of these companies. How did that compare to what we've heard and what we've seen from these companies in the past?
Well, I think that right now it's kind of ironic because these retailers are at a point where they can control probably the most that they've been able to control in the last 3 years since the onset of the pandemic. But even despite that, we actually saw some of the most conservative outlooks that we've seen in quite some time. And I think that that makes sense given what we've seen in some of the data. So revolving credit balances continue to be up at a historically high rate, up about 15%. And savings rates are well below pre-pandemic levels at present. So I think the consumer's buying on credit more, saving less. And as a result of that, a lot of these companies, like take Walmart as an example, calibrated their guidance very conservatively. Why? Well, it's pretty simple. Last year, they had to issue profit warnings and lower their full year outlooks. And I think that that's a narrative they're looking to flip in 2023.
Corey, you mentioned some of your winners. How about losers in the quarter?
Well, I talked a little bit about Gap and American Eagle, but I think very simply, it's the retailers that are more discretionary oriented, that don't have very unique catalysts to really propel them throughout the remainder of this year, in spite of what we've seen in persistent inflation. So those are two where I think that given they're predominantly mall-based, they are overstored, and the store growth for some of their higher growth segments is actually slowing, like Aerie as an example. And some of the recent acquisitions that American Eagle made, even in its supply chain acquisition in Quiet Logistics, is also likely to still going to take a while to ramp here. So I think that that's one that is likely a loser following this quarter, and then Gap would be another one as well.
All right, Corey, it's time to have a little fun here. We want to play a game. We're going to give you two stocks, and you have to pick. Some of them are both your winners. Some of them are both your underperformers. Who you think is the ultimate winner this past earnings season, or you can flip it and talk about the outlook here. Costco or BJ's, two of your winners. Who's best positioned?
Great one. I think that right now, I got to give it to BJ's following their print yesterday. It was a really impressive fourth quarter that they had with the comps up in the high single digits. Outlook that was also relatively strong from a top line standpoint, and they have a much higher mix of food versus non-food than what Costco has, and they have a lot of really nice initiatives on the grocery side that should help to underpin growth ahead.
All right, a tough one here, Gap or American Eagle?
I think American Eagle gives it the slight edge because I think that they have a little bit more that they've done on the cost side to rein costs in. Gap still has much more work to be done there, and they still have to appoint a new CEO, which they have yet to do.
All right, I got a tough one for you here. Walmart or Target?
Walmart's really gotten their act together quite nicely. They have benefited tremendously from higher income consumers trading down. They have a retail media business network that is growing at a rate of 40% year over year and drives tremendously high margins. And you also have the Walmart Plus segment that continues to grow and gain members as well. So really like everything that Walmart's doing at present, and valuation is relatively in line with historical average.
TJ
so we
Maxx?
see further upside ahead.
Oh, sorry, buddy. TJ Maxx versus Burlington. Who you got?
I think TJ Maxx, because it very simply caters to a higher income consumer, and it's much cleaner of a story right now. It's a company that's been able to drive high single digit or even low double digit operating margins, whereas Burlington over the last 12 months has had negative comps and underwhelming operating profiles. And as a result of a lot of the elevated inventory levels that many of these companies have spoken about, that's really become a treasure for both companies. But TJ Maxx has the one with pricing power and has been able to benefit from that from a financial standpoint.
Corey, we got to ask you about Nike and Lulu, two stocks that we debate all the time. Who's the winner?
For me here, it's Nike. I think Lulu might end up being perhaps the best underperform for this year with a margin profile that is, I think, frankly, a little bit too elevated. You have markdowns on the horizon that should drive lower margins ahead. That's not baked into consensus estimates at present. A mirror acquisition that has underperformed substantially, and disclosure around that segment has also been curtailed. Footwear, which is a lower margin segment, is expanding at Lululemon, and that should also hinder profitability ahead. And I think that a lot of the results that they, or a lot of the guidance, that they provided at their analyst day recently is likely to be very difficult to achieve. So Lululemon, top underperform, and much prefer Nike to Lulu.
All right, Corey Tarlow from Jefferies. Great stuff. Appreciate that, my man. Have a good weekend. All right, Josh, you are going with the yearbook theme today. Who's most likely to succeed, which of course was what you were, right?
Right, Dave.
You
this
weren't
was
life
the one
of the
I
party.
won, right? This is the one I won, or it's at least the one I'm going to say I won today, right? But when I was thinking about this one, you really have to think about a company that has positive guidance, probably up guidance, and really is looking strong headed into the next quarter, the next year. That was Deere & Company, John Deere. So John Deere reporting income that nearly doubled, more than doubled over the last year, reporting net income coming in at $1.9 billion. You can see they're doubling from what it reported last year. They also raised their profit forecast. They reported earnings on February 17th. The stock saw a nice pop that day on February 17th. And so let me take a look here. We got Deere & Company. And February 17th, the stock took a nice pop there. Still down over the last 2 months, about 10%. But investors were excited there for what Deere & Company has coming down the pike. And what I'm excited for personally with John Deere, I love the autonomous tractors. Have you guys watched any of that video? The autonomous tractors, it's actually a growing part of their business, something they're investing in more, and I think something people are excited about when it comes to John Deere. When you think about AI, to stick with our earnings theme, right? A lot more people, I think, are wondering, where are they going to go with these autonomous tractors? Is that going to eventually be all of the farm fields? Is that just going to be AI tractors?
They're a little scary.
Yeah, I think a lot of the farmers are wondering how this class action lawsuit ends up, where being able to repair your own tractor. That's a big deal for farmers across the country. All right, Josh, good stuff. Appreciate that. Let's get over to the tech sector. Laid off more than 275,000 workers since last year. That's according to Layoffs FYI, a site that has been tracking job losses in Silicon Valley since the pandemic began. More than 110,000 of which have been since the beginning of 23. For more on this and what lies ahead for the industry, we're joined by Yahoo Finance's Dan Howley. Dan, good to see you. What's coming?
That's right, Dave. This has been kind of the quarter of where the layoffs kind of started to take hold. We saw Amazon workers lose their jobs, Microsoft workers in Seattle lose their jobs, Meta, obviously, they had their layoffs, and we're expecting more to come perhaps in the coming weeks. And so really what you saw was kind of this, everything starting to settle in, I think, finally in Silicon Valley, where, you know, for years, there was nothing but job growth and opportunity. And now you're seeing that be pulled back because of that massive expansion during the pandemic that, you know, frankly was just a swing and a miss on the part of tech executives and then impacted real people's real lives. So I think going forward, what we're going to see is less hiring, more discriminate hiring, where, you know, they're going to be looking at particular areas of interest. I think, you know, part of that, obviously, with the prior conversation is going to be AI pushing forward there. A lot of companies are jumping on it. Look, some of it's hype, some of it's not. Yes, ChatGPT is an impressive technology. No, it is not the end-all, be-all of AI. No, it does not need to be in every single thing that we talk about when it comes to technology. So I think that's going to be something where we'll see hiring, though. There could still, though, be potential layoffs. You know, we were looking at that discussion, as I said, Meta potentially having more layoffs going forward. We have to see where these companies start to shake out in the next quarter or so. You know, the comparisons to the prior quarters are going to be a lot easier moving forward. You know, the stalwart in the space, Apple, they continue to do relatively well while they missed on their first quarter earnings and they saw revenue down year over year for the first time in years. They still managed to pull out a relative win compared to what Wall Street was expecting. And then moving forward, we're starting to hear chatter about people wanting to get more iPhones again. And obviously, they just released that new yellow phone to get the numbers juiced up again. So, you know, you got to wonder if we're going to see very many layoffs, but there's no telling if we're done with this cycle.
Certainly is not. All right, Dan Howley, thanks so much. Let's get back over to Josh. We want to continue with superlatives. Up now, what do we have? Most changed, most improved? What do we go with?
So it's most changed because I think that's what you're more likely to see in a yearbook, but we're sort of framing it as a most improved too, quarter over quarter. And that's Meta. When you really think about what this story has been for Meta over the last several quarters, you can see that revenue chart there. Meta had revenue falling over the last couple quarters, ticked back up this quarter, and so did the stock price with it. People were excited for this. So Meta reported earnings on February 1st, and look at how big this leg up is here. That's about 20% it popped on earnings. People excited about them returning to positive revenue growth quarter over quarter there. A couple things that stuck out from Meta over the quarter too was business messaging was interesting with what's growing in WhatsApp. Instagram Reels, we talk a lot about TikTok on this show. Instagram Reels have sort of been their response to TikTok. That's been an interesting space to watch for Meta. And when you take a look at Meta over the year as well, really been a bounce back year for Meta so far, guys. Up about 50%. But Shauna, it seems like you have qualms with the most change. So we're not going to talk about the stock here. Let's debate the yearbook superlative. Yeah. Is most change the yearbook superlative, yes or no?
No, I don't think my high school had a most change. I don't know if that's a positive or negative. We had this debate for so long. That's why I was like, we need to make it most improved to really drive home. And I think Meta is the perfect fit because Metaverse, that whole line of messaging was not working for them in 2022. They had to change it up.
If I could add one change today, they've stopped paying bonuses for Reels creators, which is a really strange timing because they were beginning to at least narrow the gap somewhat with TikTok. Really interesting announcement they made today to pause that program.
We're not changing the superlatives. I won't be most changed. We're sticking with it.
Changed.
I think they are maybe most improved, but I don't think you're going to see that in a yearbook. We're not telling someone that they improved over the 4-year period. I don't think. Anyway, up next, take a listen back to some of the biggest calls from this past earnings from the likes of Disney and Tesla. Stick around.
Continuing to recap this latest earnings season, we definitely heard some notable lines dropped on the earnings calls here. Joining us now with a recall of some of the spiciest moments from this earnings season, Ali Canal. Ali, you got a lot to pick from here. What came out on top?
A lot to pick from. And look, this was an eventful earnings season, and the calls really elaborated on some of these headlines that we heard. You know, the big one for me that sticks out is Disney. This was the first earnings call since CEO Bob Iger stepped back into that position in November. And boy, did he not hold back when it comes to some of the changes he's already implemented at the company. Take a listen.
We will be reducing our workforce by approximately 7,000 jobs. While this is necessary to address the challenges we're facing today, I do not make this decision lightly. I have enormous respect and appreciation for the talent and dedication of our employees worldwide, and I'm mindful of the personal impact of these changes.
So right off the bat, 7,000 workers gone. He restructured the business into 3 units: entertainment, parks, and ESPN. Investors so far, they seem to like what they see from Iger. The stock is up modestly year to date. We know that shares in 2022, they experienced a very rough year. But Bob Iger, he certainly made his presence known, and I felt that on the earnings call.
Indeed, he did. And a lot of question afterward about how much Nelson Peltz, activist investors, pushed him into the corner. And I know my take is maybe off my own, but that he was going to do these things regardless of whether the activist investors were pressuring him to, in terms of the reorg, and in terms of the cost cuts, and in terms of the layoffs. How much do you think was activist driven?
I agree with you. I don't think much of this was activist driven. I'm sure it was in the background of conversations, but I think Bob Iger came into this company with a very clear idea of what he wanted to do. He's very strategic. He knows that he has to pivot sometimes, but he also knows when he has to cut back. And I think that's why he decided on those operational efficiencies, why he decided to cut back on labor. So I don't think that pressure from Nelson Peltz really had much of an impact. But who knows really what goes on behind the scenes.
Glad to hear you say that. And Barry and I got into a pretty heated argument over that very subject.
She was arguing the other side of it. But I mean, he's certainly making his mark known very, very quickly. And I think that's something everyone expected from Iger. Ali, that's Disney. What else do you have? Tesla, is that one of them?
Oh, yeah, of course. We have to talk about Tesla, right? Yeah. Elon Musk, he's the spiciest on all these earnings calls. And I had to pull out this specific quote. Take a listen.
Let me check my Twitter account. Okay, so I've got 127 million followers. It continues to grow very rapidly. That suggests that I'm, reasonably popular. Now, I might not be popular with some people, but for the vast majority of people, my follow count speaks for itself.
There's just something about Elon Musk talking about how popular he is on Twitter during the Tesla's earnings call that just got me. I had to include it in this recap because, I mean, who else is like Elon Musk? There truly is no one.
He clearly was most popular senior, but I'll bet he was not. We were talking about the high school superlatives. He was definitely not. He was anything but that.
Well, he's having the last laugh now with his bank account.
Hopefully he was most likely to succeed.
Yeah, he better have been most likely to succeed. If he wasn't, I want to know exactly who won that award. This is not surprising, though, coming from Elon Musk, given the fact that he can never just step to the sidelines. He has to comment on everything, and that's always on display on Twitter.
And he is CEO of Twitter, CEO of Tesla, and it seems like, Twitter on the brain for Tesla. And I also have one more that I want to call out. This is one that, also in the media world, but one that I think was an important one for this company. I'm sort of teasing it. I'll play it here.
It really started about 10 years ago with the board, trying to think through how could this work? They both have such amazing talents and gifts, and to find a platform where they've been able to contribute is fantastic. About 2.5 years ago, we took a partial step. Ted as co-CEO, Greg as COO. We continue to just make super progress, and frankly, more and more they've been leading the company. And this is acknowledging really in formal terms how we've been operating, for at least the last few quarters.
Yeah, so Netflix CEO Reed Hastings stepping down from the company, and he said this was a plan that was in motion for a decade, and I just think this is very indicative of what's been happening across tech, across media. A lot of these old guard CEOs stepping down, making a way for new leaders to take over and kind of leave this next phase of the company, and I thought that was a big theme this earnings season as well.
Do you see Netflix in a position of leadership in the streaming wars as we go forward towards Q1, Q2?
Absolutely. I think currently they're number one. They're the company to beat. They're the most mature. They've been in it the longest. So I do think that other younger players are catching up. I think over the next few years, we're going to see a lot of consolidation. But right now, the focus has shifted to profitability. That's something Netflix already has. They are a profitable business. Can they keep that up? Can they improve their free cash flow? That's always been the main question there. So I think right now they're in a good position. And investors seem to like where they're at right now, but we'll see in the coming quarters what happens there in terms of not just them, but really all the streamers.
And an interesting pivot for Netflix into sports without paying the absurd sports media rights. Some of the documentary series have been very successful for them, and clearly their tool in getting into sports without paying a ton. Ali Canal, thank you so much. Josh, all right, every graduating class needs a class couple. Who is ours?
All right, Dave. Our cutest couple, our class couple is Ulta and Target, and really kind of what Ulta has been able to do for Target when we think about retailers and what has been discretionary versus not discretionary in spending. We've talked about that a lot this quarter. Ulta's really held up for Target, and Target and Ulta want to stay together for longer and sort of build on their relationship, if you will. They have about 300, they're in about 350 stores now, and they want to go into 400 and grow into 450 stores. Ulta actually reported just this week, and Ulta's sales were very impressive. So if you take a look at Ulta's stock today, it was reacting well to the numbers, or it was over the past couple days. And something that was interesting with Ulta is you can see the net sales were up more than 18% for Ulta compared to last year. So a big number for Ulta. And again, I think the big thing here to think about with Ulta and Target is Target continuing to grow in a consumer sector where people are still spending, right? Target has seen people stop to spend in terms of some of their merchandise, clothing maybe, but people keep buying makeup. And so that's been an interesting partnership to watch. I do want to ask you guys before we get out of superlatives, what did we have? What were the high school superlatives? I didn't get one.
What did we personally win?
Yeah, what were your high school superlatives? Anything good or no?
Athletic.
Eyes and
Most
athletic.
athletic?
Dave,
Okay, I was the most popular senior. It was
humble brag.
He asked.
Wait, Shauna has the best ones. Eyes and athletic. I feel like that's what everyone wanted.
Yeah. Although I think it was scholar athlete, to be totally transparent.
I was best leader and most school spirit. So maybe that means I'll be CEO of one of these companies one day.
Most likely to succeed, Allie. We'll put you on the board next time.
Okay, there we go.
And you?
Nothing. I said I got nothing.
That's surprising.
And that's why he's shining and leading the superlatives today.
That's why I'm here
finally,
doing superlatives.
years
to
later.
maybe eventually get one.
All right, guys. Well, as we end the day here, we want to give our vibe checks for this earnings season. Ali Canal, Josh Schaefer are still on set with us. We want to go around the horn. Ali, let me throw it over to you first. What'd you give?
Okay.
The entire season.
You know what? I'm going to be positive. It's Friday, baby. I'm going to go with good overall. And the reason I'm doing this is because I think this earnings season, we saw there was a strategy of efficiency. The word efficiency was mentioned multiple times on various earnings calls, whether it be cost cuts, layoffs, reorgs. This is something that we really saw virtually across every single sector. Of course, I think it affected tech probably the most. And it is sad to see people lose jobs, but I do think these changes were needed in order for a lot of these companies to get to that solid place in terms of profits, especially after the pandemic, and really recalibrate some of those losses. So I'm going to go with good.
Good. Okay, mine wasn't really on the meter, so we had to kind of make a new category for my read of the quarter, which was meh. If you want to spin it in another way, I would say solid, not spectacular. Those are kind of the same thing to me, but I go back to where it all started. It started with the big bank earnings. Just about every single CEO coming out and predicting a mild recession, seeing a cautious consumer. Basically what happened this quarter is we lowered the bar and we're able to barely leap over it. That's a rule I've been living by pretty much my entire career. It's all about how you set your expectations, right? I remember when I walked into that movie, Thor, Love and Thunder, I expected Ragnarok. I got garbage. So it's really about where you set the bar. Last night, guys, I watched the movie Lost City. I expected nothing very special. It was outstanding. It easily went over that bar. So it really is where you set expectations, which really they were lowered enough that a lot of companies could just barely leap over.
So it sounds like you're right on that bar with the meh.
Meh.
Meh. All right.
Meh.
My takeaway, my vibe check is that it was bad, and it's all because of the consumer, a theme that we have been talking about now for weeks and weeks and weeks. We heard it from a number of the retailers. Nordstrom was one of the companies saying that we expect elevated inflation, rising interest rates to continue to weigh on consumer spending, at least through the first half of the year. Very similar to some of the comments that we heard from executives, including Macy's, Kohl's, Target, even saying that they certainly have seen a shift in how consumers are spending. So from that perspective, from that angle, it was a very bad quarter. Josh, what about you? Upbeat?
I went with the worst. We're ending on a bad note. Sorry, I went ugly, guys. And it gets to what Dave was talking about when you think about expectations. Earnings expectations for the next quarter, when we're going to be here in a couple months talking about this again, are still declining. And I think that's something that you want to highlight. And then also when you think about the banks and what's going on with Silvergate and some of these companies, it just seems like there's been a lot of bad news over basically the last week now. You can see Silvergate here down 85% year to date. Not some good news in some of the banking sector. Also, it seems like we're going to get more interest rate hikes coming, maybe for longer than we expected. Hasn't been that good for the market thus far. Maybe won't be. Hate to end it on a sad note, but
it certainly has
feeling
not
a little
been.
grim out there.
And we'll see how it affects this current quarter's earnings. All right, guys, that does it for us today on Yahoo Finance Live. Thanks so much for tuning in. We'll see you right back here again on Monday. Have a great weekend.